23,000 jobs disappeared in July. Wall Street's answer was to close the week at a record high. That is not a contradiction so much as a translation. Bad news for the economy this week meant good news for interest rate expectations. And interest rate expectations are what markets have been trading on all year. Here's what actually happened. One correction from 3 weeks ago, and why we're bringing back a name we'd quietly set aside. MoneySpider, Watching the Financial Web, Episode 5, The Payroll Shock, Signals over Narratives. Minus 23,000. That's how many jobs the American economy lost in July against forecasts for around 80,000 gained. The previous 2 months were revised down by a further 103,000. 3 months weaker than anyone realized in real time. But here's the puzzle inside the puzzle. While payrolls were falling, new claims for unemployment benefits stayed remarkably calm, under 200,000 for a third straight week. 2 labour market data series looking at the same economy, telling different stories. We're not going to pretend to resolve that for you, it's genuinely open. And next month's data will tell us more than we can tell you today. Micro, the stocks. Keep an eye on South Korea. Its stock market had another violent week as leveraged positions in Samsung and Hynix unwound and reformed while sentiment around AI chip demand swung. But there's an important distinction here. It looked like the volatility we've been seeing elsewhere. It wasn't the same signal. The same pattern on a chart doesn't mean the same mechanism underneath it. And while South Korea whipsawed, Wall Street had its best week since April, on the back of the worst domestic data point of the month. Demos, the people. For 13 work weeks earlier this year, we called the dominant story consumer fracture, a labour market and a set of prices working against ordinary households. 3 weeks ago, a war took over the airwaves, and we paused that name on one condition. If the labour evidence came back, so would the name. This week it came back, and harder than a pause would have suggested. Not a soft print, an outright contraction, plus a 103,000 job downward revision. We're not going to pretend the pause never happened. We paused it, we said what would bring it back, and it came back. Consumer fracture resumed. Polis, the state. Three weeks ago, we were debating whether war's diplomacy was dead. This week, something more specific happened. Iran and Oman agreed the actual map coordinates for a safe shipping corridor through the Strait of Hormuz, the kind of detail you only work out if you're planning to use it. A joint statement is reportedly close. That is not a ceasefire. It is not a resolution. The American blockade continues. A Houthi group claimed another tanker attack in the Red Sea, and Iran says Washington still needs to meet further conditions. But for the first time in weeks, the diplomacy looks less like shouting and more like drafting. Flows, the capital. Oil stayed relatively calm this week in the low to mid 80s. That's the long way from the spike above $100 3 weeks ago, and at least consistent with where the diplomacy talks are going. Gold kept climbing, up around 6% on the week, and the 10-year Treasury yield hit the highest point of its recent cycle, before falling back sharply when the job numbers landed. Then came equities. Wall Street took the worst domestic data point of the month and turned it into the best week since April. Why? Because weaker growth changed the market's expectations for interest rates. Tension map. And this is where the web becomes visible. One Friday morning data print changed the market's view of the Federal Reserve. Expectations of another rate rise fell. Treasury yields fell, the dollar fell, gold rose, and equities closed at fresh records. 5 markets, 1 number, that's the signal. Master signal this week is the payrolls shock. Consumer fracture resumed. 23,000 jobs disappeared. Within hours, the market had rewritten its expectations for the Federal Reserve, but confidence is only medium. Because we don't yet know whether July marks a genuine break in the labour market or one heavily revised outlier. And because claims and payrolls are still disagreeing about the same economy, that's not noise to be ignored, it's the tension we're watching. Turning now to the observatory. Macro first. The interest bill keeps track of what higher borrowing costs are actually doing to the government's finances. The buffer indicator remains in significantly overvalued territory, and the melting anchor continues to show the massive erosion of the dollar's purchasing power in gold terms. Looking at micro, Utopia's 11, still showing Nvidia in pole position. Cape Fear remains in its 99th percentile, so almost never more expensive other than briefly in the dot-com period. And the debt garden is keeping watch on private credit, where we expect stress to emerge. On Demos, we're looking for confirmation or contradiction from the consumer. The mood of the crowd still reflects July's jump in sentiment, with the next preliminary reading due next week. Payrolls have spoken. Now we see whether the consumer agrees. On Polis, the watchtower is counting down to the midterms and the next Federal Reserve decision. So the midterms now 86 days out. Politics moves quickly. Liabilities don't. And finally, flows. The net liquidity tracker tells us how much financial oxygen remains in the system. The tide table watches the passive tide. As you'll see there, more than 100% of flows has gone into passive, so this is where price discovery is being suppressed or masked. Mind the Gap tracks yen funding levels. Because this week's job number really has changed the market's view of rates, this is where some of the consequences should eventually appear. So the question now isn't whether July's payroll number was bad, it was. The question is whether it was an outlier, or the moment the labour market finally broke with the story the rest of the economy has been telling. Claims say not yet, payrolls say look again, and now the markets are listening. That's what we'll be watching next week. Systems matter, systems leave signals. Until next week, keep watching the web.